Welcome back, everyone. Ready for another deep dive?
Always. What are we tackling today?
Today we're going deep into the world of finance, the engine of any economy, really.
Okay, I'm intrigued.
Well, did you know that things like salt and even shark teeth were used as money in the past?
Really, I had no idea.
Yeah, fascinating, right? We'll be exploring this and a whole lot more using excerpts from this academic PDF on the financial sector.
Sounds like a dense read.
It is, but by the end of this deep dive, you'll have a much better understanding of how financial markets work, what monetary policy is all about, and maybe even pick up some fun facts to impress your friends at your next dinner party.
All right, let's dive in.
So, first things first, what is money, really? I mean, we all use it every day, but what actually makes something money?
It's a good question. We kind of take it for granted, don't we?
Yeah, for sure.
Our source actually highlights 4 key functions of money.
Okay, lay it on me.
So first, it's a medium of exchange. It allows us to buy and sell goods and services without having to barter.
Right, like instead of trading a chicken for a haircut, we use money.
Exactly. Second, it's a measure of value. It gives us a common yardstick to compare the worth of different things.
So we can say that a car is worth a certain amount of money and a house is worth a different amount.
Yes, precisely. Third, it's a means of deferred payment. Essentially, this is what enables credit. You can buy something now and pay for it later.
Oh, so that's where credit cards and loans come in.
Exactly. And finally, money acts as a store of wealth. It allows us to preserve our purchasing power for the future.
So we can save money today and it will still have value tomorrow, even if prices go up.
That's the idea, though. Inflation can definitely complicate things.
True. But going back to those strange examples of money from the past, like salt or grain, what actually separates good money from bad money?
Well, the source lists several characteristics. Good money needs to be easily recognizable, portable, durable, and divisible.
Makes sense. It needs to be practical to use.
But perhaps the most interesting characteristic, and this might surprise you, is scarcity.
Scarcity. But wouldn't we want there to be plenty of money available?
It seems counterintuitive, but imagine if money were as common as pebbles on a beach.
I guess it wouldn't be very valuable then.
Exactly. If everyone had tons of it, it wouldn't buy much. This is where things like hyperinflation come into play.
Oh, right, like what happened in Weimar Germany when the government printed way too much money.
Exactly. It became practically worthless. The scarcity of money is directly related to its purchasing power.
Wow, that's a powerful example. So scarcity is key to maintaining the value of money. Now, where does all this money actually operate? How does it work within a larger system?
Well, money operates within a complex network of what we call financial markets.
Okay. Tell me more about these financial markets.
Our source mentions 3 key types: money markets, capital markets, and foreign exchange markets.
Could you break down each of those a little further? What's the difference between them?
Of course. Money markets are basically short-term lending hubs. Institutions like banks and governments borrow and lend for periods typically less than a year. It's all about managing immediate financial needs.
So it's kind of like the economy's cash register, dealing with day-to-day transactions.
A good analogy. Now, capital markets are where long-term investments happen. This is where companies issue stocks to raise capital for growth, and governments issue bonds to finance projects or cover deficits.
So if I buy a company's stock, I'm essentially investing in its long-term growth potential.
Exactly. Think of capital markets as the engine for long-term economic development and growth.
Okay, that makes sense. So money markets are for the short term, capital markets are for the long term, and what about foreign exchange markets?
Yes, foreign exchange markets, or Forex, are where currencies are traded.
Oh, right. So that's where the value of one currency against another, like dollars to euros, is determined.
Precisely. It's a global marketplace that's constantly fluctuating, impacting everything from travel costs to import prices.
So when I see the exchange rates changing every day, that's the foreign exchange market at work.
Exactly. And it plays a critical role in international trade and investments.
Now, the source material also mentions something called futures in foreign exchange markets. What are those?
Futures contracts are essentially a way for businesses to lock in an exchange rate for a future transaction.
Okay, so if I'm importing goods from, say, China, I could use a futures contract to protect myself from currency fluctuations.
Precisely. It helps businesses manage risk and plan more effectively when dealing with international transactions.
That's a really useful tool. Now, switching gears a bit, Who decides how much money is actually circulating in an economy?
That's a great question. It's all about what we call the money supply, and it's influenced by a number of factors.
Okay, what are these factors that determine the money supply?
Our source explains that it's primarily determined by three things: open market operations, the reserve requirement, and the policy interest rate.
Okay, I have to admit, open market operations sounds a little intimidating. Can you explain that one in simpler terms?
Sure, it's actually not as complicated as it sounds. Essentially, the central bank, which is like the conductor of a country's financial system, buys government bonds.
Okay, and what does that have to do with the money supply?
Well, by buying these bonds, the central bank injects money directly into the economy. It's a strategy similar to what's often called quantitative easing.
So the central bank can actually create money by buying bonds.
In a way, yes. And this increase in the money supply can have various effects on the economy.
Interesting. What about this reserve requirement? What is that all about?
The reserve requirement is the percentage of deposits that banks are required to keep on hand. So let's say you deposit $100 in your bank account.
Okay.
The bank can't lend out that entire amount. They have to keep a certain percentage, maybe 10%, in reserve.
So they always have enough cash available if customers want to withdraw their money.
Exactly. It's a safeguard for the stability of the banking system.
It's like a financial safety net. And finally, how does the policy interest rate factor into all of this?
The policy interest rate is the rate at which banks can borrow money from the central bank.
Okay.
By adjusting this rate, the central bank can influence borrowing and lending activity across the entire economy. For example, if they raise the policy interest rate, it becomes more expensive for banks to borrow.
So they're less likely to lend money to businesses and consumers.
Exactly. And that can slow down economic activity and potentially reduce the money supply.
Wow, so the central bank really has a lot of power to control the flow of money.
They do. It's a delicate balancing act, trying to keep the economy stable and growing. Now, one thing that often surprises people is that most money is actually created through bank lending.
Really? How does that work?
It's a fascinating concept called fractional reserve banking.
Okay, break it down for me.
Banks don't need to have all the money they lend out physically on hand. They only need to hold a fraction in reserve, as we discussed earlier.
So going back to my $100 deposit, if the reserve requirement is 10%, the bank can lend out $90 of that to someone else.
Precisely. And that $90 ends up in another person's account who can then spend it, and so on.
So the money keeps circulating and multiplying through this lending process.
Exactly. That's how new money is created in the economy.
Wow, that's amazing. But it also seems like it could be a bit risky if banks aren't careful.
Absolutely. That's why responsible lending practices and regulations are so crucial.
Makes sense. Okay, so we've talked about the supply of money, but what about the demand for money? What influences how much people want to hold?
Another great question.
Well, I'm all ears.
Our source lists a whole bunch of factors. One of the biggest is interest rates on loans.
Makes sense. If interest rates are high, borrowing is more expensive.
Right, so people might prefer to hold on to their cash instead of taking out loans.
So it's all about weighing the costs and benefits. What are some of the other factors that influence the demand for money?
Well, there's also the expected number and value of transactions we anticipate making. If we think we'll be spending a lot, like during the holidays, we'd naturally want to have more cash on hand.
So our demand for money goes up when we expect to spend more. Makes sense. But what about holding on to money instead of investing it? How does that play into the demand?
That's what economists call the speculative motive. If people believe that assets like stocks or bonds are likely to lose value, they might prefer to hold cash, even if it earns very little interest.
So it's about balancing potential returns with the perceived safety of cash.
Exactly. And this can be influenced by a lot of things, like how volatile the market is or the overall economic uncertainty.
It's like choosing between a risky investment with potential gains and the security of just keeping your money safe and sound. Sometimes that's a tough call. Are there any other factors that come into play?
Absolutely. Changes in a country's gross domestic product, or GDP, can also influence demand.
GDP, that's like the total value of goods and services produced in a country, right?
You got it. And usually a growing economy leads to a higher demand for money.
Because businesses and consumers have more opportunities to spend and invest.
Precisely. As the economy expands, more money is needed to support all that increased economic activity.
It's like needing more fuel for a bigger engine.
A perfect analogy. We also can't forget about the impact of financial innovation.
Financial innovation. What do you mean by that?
Things like the rise of debit and credit cards, mobile payment apps,
Oh, right. I hardly ever use cash anymore. It's mostly cards or my phone.
Exactly. These innovations affect how much physical cash we actually need to carry around. They've really changed the way we use and think about money.
It's true. What about holding money for emergencies? Does that factor in?
That's what's known as the precautionary motive.
Hmm.
We might hold on to more money just to cover those unexpected expenses.
Like car repairs or medical bills.
Exactly. It's about having a financial cushion for those unpredictable moments in life.
I've definitely been there. Always good to have a little something set aside, just in case. Is there anything else we should consider?
Yes, the anticipated rate of inflation can play a role. If we expect prices to go up in the future, we might want to hold on to more money now to maintain our purchasing power.
So inflation can erode the value of our savings over time. That's a scary thought.
It definitely is something to keep in mind.
It seems like there's this constant balancing act between all these different factors, both on the supply side and the demand side.
You've got it. The demand for money is just as dynamic as the supply.
Now, can we talk about interest rates? They seem to be at the heart of so many financial decisions.
Absolutely. Interest rates are kind of like the price signals in the financial world. They influence so much from borrowing and saving to investment decisions and ultimately economic growth.
Okay, I'm listening.
But before we get too deep into it, it's super important to understand the difference between the nominal interest rate and the real interest rate.
I've always been a little fuzzy on that. Can you break it down for me?
Sure. The nominal interest rate is just the stated percentage increase you pay when you borrow money. So if you take out a loan at a 5% nominal interest rate, you'll pay back the original amount plus 5% interest.
Okay, that makes sense. So where does the real interest rate come in?
Well, the nominal rate doesn't take inflation into account.
Right, inflation, the rising prices of goods and services.
Exactly. So the real interest rate measures the actual increase in purchasing power the lender receives after factoring in inflation.
Oh, I see. So if inflation is high, the real interest rate could be much lower than the nominal rate.
Precisely. For example, let's say you borrow €100 at an 8% interest rate. When you repay the loan, you'd owe 108, right?
Right.
But if inflation was 5% over that year, the real interest rate is actually only 3%.
Wow, that's a big difference. It seems like understanding inflation is really important when it comes to making financial decisions.
Absolutely. This interplay between nominal and real interest rates is a key reason why interest rates are such a powerful tool for managing an economy.
So central banks use interest rates to try and keep inflation in check.
Exactly. They're constantly adjusting interest rates to try to influence economic activity and control inflation.
It's like they're walking this tightrope, trying to keep the economy balanced and growing.
That's a great way to put it. Low interest rates can encourage borrowing and investment, which can boost economic growth. But if rates are too low for too long, it can lead to inflation.
And if they raise rates too high, it can stifle growth. It's a delicate balance. Okay, so we've talked about the forces behind money, the markets where it flows, and the crucial role of interest rates. But who are the actual players in this financial system?
Good question. Our source lists a whole bunch of financial institutions that operate in Ireland, each with its own specific role.
Are there any that our listeners might not be familiar with?
Well, we've all heard of banks, but what about bureaus de change?
The bureaux de change, those places you see at airports to exchange currency?
Yes. They might seem a bit old school in today's digital age, but they're still around, especially for those last-minute travel needs.
I guess with travel cards and online currency exchange, it's easy to forget about them. What else is on the list?
Then we have credit unions. These are member-owned financial cooperatives that offer banking services with a focus on community and member benefits.
So they're like banks, but with a more personal touch.
Exactly. They're known for their personalized service and commitment to local communities. Then, our source mentions something called money transmission businesses. These are companies like Revolut or Wise, which provide digital platforms for sending and receiving money.
Oh, right. I use those apps all the time for international transfers. They're so convenient.
They are, and they often have very competitive exchange rates, which is a big plus.
Any other interesting institutions on the list?
We also have what are called home reversion firms.
Home reversion firms. I'm not familiar with those. What do they do?
They offer homeowners a way to access the equity they've built up in their homes without having to sell.
So they can get some cash out of their homes without having to move.
Exactly. It's an alternative to traditional mortgages or loans, and it's particularly popular with older homeowners.
That's an interesting option I hadn't thought about before. Okay, so we have all these different players in the financial system, but who makes sure everyone's playing by the rules?
That's where financial regulators come in. They act as the referees, safeguarding stability, protecting consumers, and providing economic advice to ensure things are running smoothly.
So they're like the watchdogs, making sure everyone is behaving
It's
themselves.
a good way to put it. And at the top of that regulatory pyramid are the central banks.
Like the European Central Bank or ECB.
Yes, the ECB for the Eurozone and the Central Bank of Ireland for, well, Ireland. Their main job is to keep prices stable, which means keeping inflation under control.
Okay, that sounds important.
It is. They also manage the money supply using tools we discussed earlier, like open market operations, reserve requirements, and interest rates.
Right, those levers they can pull to control the flow of money.
Mm.
But what specific powers does the central bank have to control credit creation?
Well, we've already talked about open market operations and the reserve requirement, but they can also use something called supplementary deposits.
Supplementary deposits, what are those?
They can require commercial banks to hold more of their funds with the central bank.
So that limits how much the banks can lend out.
Exactly. It's another way to tighten the reins on credit creation. They can also manipulate key interest rates, like the rediscount rate and a short-term facility rate. These are rates at which commercial banks can borrow from the central bank.
So if they raise those rates, it becomes more expensive for banks to borrow.
Precisely. And that discourages lending and reduces credit creation.
Wow, they have a lot of tools in their toolbox. What else can they do?
They can engage in foreign exchange swaps.
Foreign exchange swaps, what are those?
It basically involves temporarily exchanging foreign currency for euros to increase the lending capacity of commercial banks.
Oh, I see. So they can influence the amount of credit available by controlling the amount of euros in circulation.
You got it. They can also adjust the primary liquidity ratio, or PLR. This dictates the ratio of cash that banks must hold relative to their deposits.
So if they increase the PLR, banks have to hold more cash, which means they can lend out less.
Exactly. It's another way to influence the amount of credit in the system.
It's fascinating how they can fine-tune things by adjusting these different ratios and mechanisms.
It is quite a complex system. And beyond all that, they can also issue advice or directives to commercial banks, guiding their lending practices to promote economic stability.
So it's not just about setting numbers. They actively shape the financial landscape through guidance and recommendations.
Precisely. They have a lot of responsibility. Okay, now let's shift gears and talk about the euro's impact on Ireland. Remember the days of the Irish punt?
Vaguely. It seems like a lifetime ago. What were some of the biggest changes after the euro was introduced?
Well, one of the most immediate impacts was the ease of foreign travel. No more messing around with currency conversions or trying to figure out exchange rates.
Yeah, traveling within the Eurozone definitely became a lot simpler.
Exactly. And it also made it much easier to compare prices across different countries.
That's true. No more wondering if you're getting a good deal or not. What about the effect on prices within Ireland?
That's interesting. Our source points out that there was a tendency to round up prices, which contributed to inflation in those early years.
So something that cost, say, 3.87 punts could suddenly become 3.99 euros.
Exactly. It's funny how these seemingly small changes can actually have a big impact on the economy.
It's true. Were there any other significant changes?
Well, the euro also led to a lot more competition in the financial sector. Irish consumers and businesses suddenly had access to a much wider range of financial products and services from institutions across the whole eurozone.
So more choices and potentially better deals for consumers.
Exactly. But it also put pressure on smaller domestic financial institutions to become more competitive.
Right, it's a double-edged sword. Consumers benefit from more competition, but some businesses might struggle to keep up. What about the impact on the Irish government?
Well, besides losing control over monetary policy, the euro also ushered in an era of much greater fiscal prudence.
Fiscal prudence, what does that mean?
Essentially, being more careful with government stability across all the member states.
So Ireland had to stick to stricter fiscal policies.
Exactly. Things like limitations on budget deficits and government debt.
So joining the Eurozone was like joining a financial fitness club, encouraging the government to adopt healthier financial habits.
That's a great analogy. And while some people saw these restrictions as limiting the government's flexibility, others argued that it was a good thing, promoting responsible fiscal management.
It sounds like a complex issue with a lot of different perspectives.
It definitely is. And it makes you wonder, has the euro been a net positive or negative for Ireland?
That's a tough question. There are definitely pros and cons to consider.
Exactly. It's a debate that economists are still having today. The euro's impact has been widespread, affecting everything from prices to government policies.
It's a topic worthy of further exploration. Now let's zoom out to the global stage and talk about exchange rates.
Okay, let's do it.
They can have a huge impact on everything from our personal finances to international trade.
Absolutely, and those currency values are constantly fluctuating.
So what causes these fluctuations? What factors influence exchange rates?
Well, our source highlights 6 key factors. The first is something called purchasing power parity, or PPP.
Purchasing power parity. Can you explain that one?
Sure. PPP basically suggests that in a free market, exchange rates should adjust so that the same goods cost roughly the same in different countries once you take the exchange rate into account.
So like if a cup of coffee costs $3 in the US and $2.50 in France, the exchange rate should be around $1.20 per euro.
That's the basic idea. Of course, it's more complicated than that in the real world, but it illustrates the core concept. The second factor is the balance of payments.
Balance of payments. What is that?
It basically tracks a country's transactions with the rest of the world.
Like imports and exports?
Exactly. If a country exports more than it imports, it has a trade surplus, which tends to strengthen its currency.
Because there's more demand for its currency.
Right. And conversely, a trade deficit, where a country imports more than it exports, can weaken its currency.
So if a country is selling more goods and services to the world than it's buying, its currency becomes more valuable. It's like supply and demand on a global scale.
Exactly. Now, the third factor that influences exchange rates is speculation.
Speculation, you mean like investors trying to profit from currency fluctuations?
Precisely. If speculators believe a currency is going to rise in value, they'll buy it, driving up demand and increasing its price.
And if they think it's going to fall, they'll sell, pushing the price down.
You got it. Their actions can create these self-fulfilling prophecies in the market. The fourth factor we need to consider is the role of multinational companies.
Multinational companies? How do they factor in?
Well, these companies operate in multiple countries, so they're often dealing with huge amounts of foreign exchange.
So if a giant company like, say, Apple decides to convert a bunch of dollars into euros, that could shift the exchange rate.
Precisely. Their transactions can have a noticeable impact. The fifth factor is central bank intervention, which we touched on earlier.
Right, central banks can step in and buy or sell their own currency to try and influence its value.
Exactly. They often intervene to stabilize their currency or to try and achieve certain economic goals. Any guesses on the sixth and final factor?
Let me think. Could it be international agreements or policies?
You nailed it. Sometimes countries agree to peg their currency to another currency or to a basket of currencies.
So they fix their exchange rate instead of letting it float freely.
Exactly. For example, some countries peg their currency to the US dollar. It can provide stability, but also limits their flexibility. What do you think about fixed versus floating exchange rates?
Well, it really depends on a country's specific circumstances and what they're trying to achieve. A fixed exchange rate system, as the name implies, keeps the value of a currency fixed against another currency or a basket of currencies.
So it's predictable, you always know what your currency is worth relative to another currency.
Exactly. That can be a big plus for businesses involved in international trade. It reduces uncertainty and makes it easier to plan.
But I imagine there must be some drawbacks to this fixed system.
There are. For one thing, maintaining a fixed exchange rate can require a lot of effort from the government and the central bank.
What kind of effort?
Well, they might have to take some unpopular measures, like raising interest rates or even implementing austerity measures, just to defend the peg if their currency comes under pressure.
So it can limit their policy options and potentially impact economic growth. Exactly. And in some cases, if the pressure gets too great, they might have to abandon the peg altogether, which can lead to a lot of volatility.
So there's a risk involved. What about floating exchange rate systems? How do they work?
Under a floating system, currencies are allowed to fluctuate freely based on market forces, supply and demand.
So if a country's economy is doing well, its currency might appreciate in value, and if it's struggling, its currency might depreciate.
Exactly. Proponents of this system argue that it allows currencies to adjust naturally to economic conditions.
It's like a self-regulating mechanism.
Right. And it can also help a country achieve a balance of payments equilibrium.
Okay, remind me, what's balance of payments again?
It's basically a record of all the economic transactions between a country and the rest of the world. including things like imports, exports, and investments.
Right, right. So if a country imports more than it exports, its currency will likely weaken, making those imports more expensive and its exports more competitive.
Exactly. That can help correct trade imbalances over time.
It's like a feedback loop.
Exactly. But of course, there are also downsides to floating exchange rates.
What are some of the drawbacks?
While all that fluctuation can create uncertainty for businesses and investors.
That makes sense. It's harder to plan when you don't know what your currency is going to be worth in the future.
Exactly. It can make businesses hesitant to engage in international trade or to make long-term investments.
It adds an element of risk.
Precisely. And it can also make borrowing more expensive for some countries. If lenders perceive a currency as being volatile, they might charge higher interest rates to compensate for the risk.
So it's a trade-off. Stability versus flexibility.
You got it. Each system has its pros and cons, and the best choice really depends on a country's specific circumstances and goals.
There's no one-size-fits-all solution. It's all about finding the right balance. Now, before we wrap up, the source mentions something interesting about the relationship between Ireland and the UK in the context of the euro.
Ah, yes. Even though the UK never adopted the euro, it's still a major trading partner for Ireland.
Right. Didn't the source say something like a third of Ireland's imports and a quarter of its exports are with the UK?
Something like that, yeah. Which means that what happens in the UK, like for example Brexit, can have a pretty big impact on the Irish economy.
That's a good point. It's a reminder that even though Ireland is part of the Eurozone, its economy is still very much connected to the global financial system.
Absolutely. And understanding these connections is crucial for making sense of how the financial world really works.
Well, I think this deep dive has given us a lot to think about. We've covered so much ground, from the basic functions of money to the complexities of financial markets and even the impact of global events on local economies.
It's been a fascinating journey.
I agree. And it just goes to show that finance is anything but boring.
Definitely not.
Well, on that note, I think it's time to wrap up this episode. I hope you've enjoyed learning about the fascinating world of finance as much as we have.
Me too. Always a pleasure to delve into these topics.
Remember, knowledge is power, especially when it comes to understanding something as important as finance. Until next time, happy diving.